Hey, DC Mac, I just wanted to do a quick introduction to exchange rates to talk you through what this looks like and how to calculate what we're doing. So when we've been talking about imports and exports with trade, one of the things we've been talking about is people buying and selling between two countries. So let's say the United States sells cars to Mexico, maybe Mexico buys tractors from Canada, maybe Canada sells maple syrup to the United States. All of those transactions are happening all day, every day. Um, but the thing we haven't talked about is that for all of these transactions, there are different national currency. And so when the United States buys from Mexico, do we pay in dollars or pesos? We're not really sure, right? When Canada sells maple syrup to the United States, do we pay them in American dollars or Canadian dollars? So we have to figure this out. So the thing that you need to know is each country must be paid in their own currency. And that is going to be an essential fact for both exchange rates and for when we get to what we call the foreign exchange markets in your next part of this unit. Um, so in this case, the buyer or the importer has to exchange their currency for that of the seller or the exporter. So if I'm going to go into Mexico and buy a car, I can't pay them in American dollars. They want to be paid in pesos. So it's on the buyer to show up with the right kind of money to make the transaction happen. So what we call is the Forex market. And in the foreign exchange market, there's almost a $4 trillion turnover every day when people go in and they buy, sell, and exchange their currencies. Now, just like the stock market, you could, in theory, invest in currency, which is super risky. But if I think that the say the Russians are doing great, maybe I take the American dollars and I switch them into Russian rubles and I let them sit there and I let them gain in value compared to the American dollar. And then when I switch them back, I will have more dollars. It's really risky and kind of insane, but it's something that people do. But within these markets, we have to know that we have to look at only two countries or currencies at a time. We can't look at a whole bunch of different things. So for example, we have American dollars and British pounds. Well, if the price of the currency is $2 equals 1 British pound, then we have to make sure that we do the calculations appropriately. So the exchange rate depends on which currency I'm converting. So the price of $1 in terms of pounds is actually $1 equals half of a British pound. And then in the other case, the price of a pound in terms of dollars is £1 equals $2. So we have these exchange rates. We have fixed exchange rates and floating exchange rates. It used to be that everything used to be a fixed exchange rate where the government keeps the exchange rate targeted, but this takes a lot of doing in the background, a lot of monetary policy, a lot of fiscal policy, a lot of big decisions to maintain a ratio where I say I will always make sure that $1 equals, say, 100 Japanese yen. That's really hard. Currently, the only country that still has an official fixed exchange rate is Hong Kong. Most countries these days have what we call a floating exchange rate, where the country lets the exchange rate go where the market takes it. It helps to insulate us from recessions and other drama in other nations. It helps us to focus on making our nation stronger versus really making sure the exchange rate is right. So I can pull exchange rates from a bunch of different places. My favorite is xe.com, where they're going to show you that you've got $1 and how much you can buy for US dollars. So it'll do the math for you a little bit for current exchange rates. So let's say I have $1, I better be able to exchange that for $1. So 1 to 1 is a good ratio. But in this case, if I have $1 and now I can exchange it for 0.81 euros, then all of a sudden I've got euros. And on the inverse line, what it shows me is $1 equals 1.2, or I'm sorry, €1 equals $1.22 in the United States. And so we've got charts like this that are always out there helping us. One of the things that we have to deal with in exchange rates is something called purchasing power parity. And so purchasing power parity is something where we say, in the long run, exchange rates should move towards a rate where everything is the same. A great example of this is when you go out to get food. There are McDonald's around the world. And so in theory, if I go to buy McDonald's lunch in America and then I go to buy McDonald's lunch in Russia, it should cost me the same. So we know that the sandwich is the same, the fries are the same, the drink is the same. So the cost should be the same, just exchanging currencies. Well, the concept of purchasing power parity says that doesn't always happen. And we know that doesn't always happen. So some countries are overvalued and undervalued based on how this goes. Funnily enough, there's an Economist magazine that does calculations like this. They publish the Big Mac Index. Sometimes it's every year, sometimes it's every 6 months. But in this case, here's one from July of 2017, where they've given you a index of what should things cost you based on the value of your dollar. So the darker the red it is, the better deal you're going to get. The darker the blue it is, the worse deal you're going to get. And so in this case, we can see that from July 2017 to July 2018, things changed in the world. So the price of a Big Mac in America in January 2018 was like $5.28. In China, it's only $3.17. So basically what we're saying is if you go and buy it in China, you're getting a deal. So when we talk about changes in money, we have to talk about how things relate to each other. Because we're only comparing one currency to one other currency, there's always going to be a winner and there's always going to be a loser. So if you're the loser, we say that the value of your currency has depreciated. So the loss of the value with respect to the other foreign currency, it takes more dollars to buy the other currency. The dollar is weaker. So let's say today I can buy a euro for what we say $1.22, but tomorrow it takes me $3 to buy 1 euro. I'm paying more to get the same thing. My money is buying less stuff. On the other side, if you're the winner, we call it appreciation. It's an increase in value of your currency. So let's say today I could buy 100 Japanese euro for $1, and tomorrow I can buy 200 Japanese euro for $1. I get a better deal for my same amount of money. The dollars tend to be stronger. So we can look at this over time and compare two different sets of exchange rates. So if we're talking about the pink box on the left being the first one and the purple box on the right being the second one, so the US dollar used to buy 0.94 euros in our pink box on the left, and in the purple box the US dollar buys 0.81 euros. We would say that the US dollar has depreciated because it's buying less, and the euro has appreciated because it's buying more. And that's kind of how that works. You are, in your next homework assignment, going to need to calculate exchange rates. And it's not very difficult. So the first thing you're going to do is find out what's the exchange rate. So if I know my exchange rate is $1 American buys $1.20 Canadian, that's my ratio. Okay, so then I'm going to set that up on my problem. I'm going to say, okay, 1 US dollar is 1.2 Canadian dollars. Step 2, I've got to figure out what I'm changing. So if the problem says I've got to exchange $20 American for Canadian dollars, and I've got to figure out what the heck I'm doing, that's what I'm looking to do. So I'm going to set up a problem. It's going to be a basic sort of algebra situation. I'm going to keep the US dollars both on the top, Canadian dollars both on the bottom. So I'm going to keep my ratio 1 US dollar for 1.2 Canadian dollars. I have 20 US dollars over here on the right, and I'm just going to calculate for X. So then I'm simply going to cross multiply. So X is going to equal 20 times 1.2. So X tells me that in this case, 20 US dollars is going to buy me 24 Canadian dollars. Hope that helps, and good luck on your homework.